Hi, I'm Steven Van Metre, and welcome to your Wednesday night premiere, where we take about 15 minutes every Monday and Wednesday night to take a look at some markets. Still don't make a lot of sense, and that is because we're now seeing crude oil prices collapse. As I've said, there was going to be continued inventory builds. Now, you get this during monetary decelerations. The market went bullish on oil, but it doesn't work that way. When you have monetary deceleration, asset prices, including oil, and demand fall along with price. But the market said, no, we're bullish on that. So right now, everything, you've got yields down, oil down, lumber down, and stock market up. And it just doesn't make a whole lot of sense at all. Now, there's some interesting things coming up. We've got the G20 meeting in Osaka, Japan coming up, and President Trump has said that he expects to meet with President Xi. Now, there have been no preparations made for this meeting based on sources that handle this. It's not like, hey, let's have a meeting, hey, you want to just go in the room and chit chat real quick? That's not how it works. There's got to be a setup for this. People have to do their job. And right now, if that meeting doesn't happen, President Trump has threatened to enact 25% or more on 300 to 325 billion worth of Chinese goods. That won't spell good news for the market, as people still remain super bullish on stocks. The other issue we have is corporate share buybacks. In about a week before that meeting, start to go into blackout period. And according to Goldman Sachs, who looked back at last year this time, said we are anticipating at least or somewhere around a 35% reduction in amount of money flowing into corporate share buybacks. So you've got this market that's kind of, you got interest rates teetering on the edge of a cliff, ready to go. You've got oil down, you've got lumber down, and you've got a market that's overheated for sure. So a lot of interesting things coming up. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This channel is not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Own personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. Now today, I do want to focus, and sadly this is my fourth record of this because I normally do this totally in one cut. I don't know what's going on today, but the last cut I got to the end and we ran out of time. So I'm going to go a little bit quicker because I want to show you this really cool Wyckoff double bottom chart and how it relates to the gold miners. I'm doing a bigger piece, a write-up for not this Friday, but next Friday on the gold miners and why there's such a big opportunity coming there. Now, let's first go to the web browser, and I want to start with... Wait a minute. There it is. Okay. The McClellan Summation Index, which is a proxy for liquidity. And now I said when it normally gets below zero, you start to see a sell-off in equities, and we haven't seen it. But it's down at minus 300, and it's not stopping. It's not rebounded with this recent bounce in stocks. And that is telling you that there's something wrong with the plumbing underneath. Again, with every other index headed lower, except stocks, it tells us the stocks are headed down. Looking at the National Weather Service, we've got rain, and more rain coming to the Midwest growing region as crops emerge. And people that follow crops and understand that know that plants do not grow very well in wet ground. And you've got a lot of rain coming over the next week. And if you push that out to the next 2 weeks, you see there is above average and persistent rain coming. And this is not good for all the flooding and for the crops that have been planted, they're going to try to grow. This is very bullish for the agricultural commodity sector and could be potentially dangerous, as we now have learned that a massive locust infestation has hit Italy, and they said this is the worst they've had in 60 years. Now let's take a look at crude oil data. Unlike a lot of other people who sell their research, I don't. You can go to zerohedge.com and see this. Every week they post the API and Department of Energy data. But this week, which is a little unusual, they posted the U.S. crude oil inventory data. And it says we're back up at July 2017 levels, a 2-year high. And you can see just how high crude oil inventory are. You can almost see that here's the bull market. And we should have had a recession here in 2016 because look at how much crude oil rose. But the market saw this and said, no, inventories are headed way, way, way down. We're going to be super bullish on oil. And speculators took a large position on it. Meanwhile, the smart money said, hey, fools, we are going to take the opposite position of that. And now look, we're near at 2-year highs and not far from moving into all-time record territory for crude oil inventories. It tells you very clearly that the demand for not only oil, but just consumer demand in general is falling. The other interesting thing I learned today is the port of Long Beach, which is one of the busiest shipping ports in our country, is overloaded with sea trains. They've got buildings filled, stacks of these things outside. They are loaded to the gills. And what happened, and I knew this was going to happen, you can almost say this is why the market got so bullish on stocks and why they're going to be super wrong as we go into second quarter earnings here. I think I may have, if I said fourth quarter or third quarter blackout, I meant we're going into the second quarter corporate share buyback blackout period toward the end of this month. Is what companies did is they said, hey, these tariffs are coming and that's going to cause prices to rise because we can get away with it. We can raise prices and be like, well, it's not our fault. You blame them. Blame Trump. So we're going to raise our prices. We're going to buy all this inventory cheap down here. And when the trade wars are over, we're not going to lower our price. And we're going to make the difference on the spread. Really, really smart. Except you never do that during a period of monetary decelerations because in periods of monetary decelerations, there's less money, so there's less consumer demand, and so consumers just can't buy as much stuff. And now what happens is you get boatloads of inventory that's clearly not moving, which means corporate profits and earnings are going to go down. Going to be very interesting. All right, so let's hit up the charts. And then we will get into the primary focus of this. Now, on the third failed version of this, I started with ag commodities. So I'm going to follow the same results and see if hopefully you do not hear me say I'm recording a fifth or sixth version of this. So ag commodities are now over their 100-day moving average in blue. You've seen there's more rain coming. This is very, very bullish for this sector. We'd like to see prices break over this purple line overhead resistance about where the 200-day moving average is. From there, we need to see them continue to rise up to this level and break out over here. And then after we get to this structure here, what you see here is sellers. And what you want to do is see sellers become buyers, because once we get over this upper green line here, there's nothing but blue sky in terms of price support. So you don't have a lot of people that are looking to re-enter the market and sell because at this point, they're bullish. So this is big upside potential for this sector. All right, let's take a look next at the broad stock market, the S&P 500. And I want to kind of mention on that NASDAQ McClellan chart, this was October, and remember when the McClellan Summation Index said, hey, there's a problem, but markets kept trying to rally before they plunged. So here we are trying to rally. Stocks held their 200-day moving average, or 50-day moving average, held support here, and it looks pretty good. In fact, people keep talking about all-time highs, 3,000, 3,200. And the reason you hear people say that is because there's a lot of speculation in this market. A lot of people borrow money, taking option contracts, or other speculative positions through futures contracts. And every month that the market's not making new all-time highs, they have a cost that they have to bear to hold those positions. So what happens is they just ratchet up now 3,200, I meant 3,300, 3,500, 10,000 on the S&P. That's what happens. They keep pushing their bar up because their profit margin has to be adjusted based on their underlying expense. So again, we have stocks which are completely in denial compared to interest rates, crude oil prices, and commodities in general. So we have a market that is completely in denial of itself, but nevertheless, that's where it's at. Let's take a look at this 10-year Treasury yield. It's consolidating here now, just for full disclosure. I did adjust this dotted line up and this solid line up a little bit because I had them off slightly. So here we see it's consolidating. Now, a lot of people are shorting the bond market again because when you get a big dislocation between any security's price and its 50-day moving average, people assume that this case yields need to rise up to the 50-day moving average, which would be around this 2.3% range. So they've come in and they've heavily shorted the market. And what's interesting is the market is not responding. In fact, this week so far, we've seen very strong auctions, treasury auctions, and most of the money is coming from foreign investors, which all we've been hearing for the last couple of years, foreign investors will not buy U.S. bonds anymore. Well, they are. Now, the focus of where this is going to go is down to the 7 to 10 year treasury bonds, which are about to break out. Now, for those in the legacy portfolio, that meaning those who are not in a portfolio shield strategy, which means you predated that, we are in bonds, and I'm looking at making an adjustment. In fact, I did the prep work to switch out of the 7 to 10 year bonds into the longer term bonds, because you can see these 20-year plus treasury bonds are holding nicely on the support level. And if they break out over this resistance, there's not much holding them back before they catapult higher. And it's very, very simple. When it comes to bonds, the longer the maturity, the bigger the payday. And so I just want to make sure these things hold support. We'll see the auction tomorrow. Maybe we'll go a little bit into next week, let the Fed meeting hit. But literally, I've got this thing ready to push a button, make a phone call, and get it all taken care of. So it's all set to go because there's a lot of upside here. And when that hits, it's going to yank those equity markets straight down. That's where opportunity is going to come. All right, so let's go and take a look at crude oil. How much time we have left? Yep, see, I'm going to fall in the same trap as before. All right, crude oil is sitting at just above support here. Support's right around in the $50 price range. Today it closed at just over 51. And if it fails to hold support here, crude oil prices are headed to 42. I'm going to just predict right now they will get down here and they will double bottom, and people will get excited and drive crude oil prices back up to 50. And before that rolls over a second time. That's just going to be my prediction. We'll see. But the oil and gas producing stocks are telling us something different. Where'd they go? Here they are. They are telling us, as they come back to their early 2016 and late 2018 lows. In fact, you can see they're trading in the $24 range, right above the lows of 22. So not much farther for them to fall before you get a quadruple bottom, which again could be a bullish indicator for some. But based on the fact that crude oil inventories are high and going to continue to rise, that tells you there's going to be a huge plunge in crude oil prices. Monster opportunity. Now, keep this in mind. This is not a short-term play. This is a long-term play to wait till they come down and then buy, because this is where the smart money is going to buy, and they are short this market. So hold on to that thesis. Now let's go and switch over to this Wyckoff chart. I don't have time to show you where I got it, but this is really cool. So this is a Wyckoff double bottom, and I'm going to show you the gold miners. So you can see what happens is there's a big sell-off. They hit a supply zone. They find buyers, rally up to a higher supply zone, hit resistance, come back down, and then they rally up, pull back down to the top of the supply zone, create what looks like a very bullish indicator. Buyers drive in, the sellers come down, knock it back down to the original supply zone where it lingers and consolidates as all of these people flood out of the market or out of the position. And then once the supply is chewed up, it rallies. Now check this out. I'm going to go, I've got to click around here. Let's look at the large gold miners. Darn it. There we go. When Alt-Tab is not your friend. Okay, here we go. Big sell down here. You can see this is bottom, second bottom. Prices rally. Come back down to the prior level of support, which was resistance. Rally back up here, get people super excited. Hey, breakout, breakout, breakout. And then the rug gets pulled, and it should come back down into this zone here. This is where we want to buy. Now, those of you that have been with me a long time know that this was where I wanted to buy originally eons like 3 years ago, and prices never got back down here. It looks real similar, but check out what I'm a little more interested in is the junior miners. Bottom one, bottom two, rally back up near where the original cascading fall was. Get people excited. The bottom up here, buy. Reverse it down to the top of the supply zone, so kind of right in here. And then bid prices back up, get people bullish to get them excited. I want to buy, it's going to break out. Here it goes. and the next rug pull should yank this down to here. That, again, is exactly where we want to buy. So looks really cool. And I wanted you to see that because as I've been studying more in the Wyckoff charting patterns, I saw them like, oh, that's the gold mine stocks. And that would set up a huge monster rally. And we're starting to hear hedge fund managers come out and say that they think gold is going up, which translates to, I just bought a bunch and legally I can get away with coming on the news and be like, hey, you should buy gold. Why? Well, I just loaded up on it. So big players we don't know where they bought, but we know they're buying. So again, all supports the narrative that something interesting is coming, and maybe it's the second quarter earnings announcements and corporate share buyback blackout that give us our opportunity. But just so you know, we're ready to roll. So until Friday, I'm Steve Van Metre. Bye now.